Have you ever wondered what qualifications you need to secure an FHA mortgage? It's a question that many ponder when considering home ownership. Navigating the world of mortgages can feel like a maze, but fear not. We're here to help clear the path. From credit score requirements to employment history, from debt to income ratios to property standards, there's a lot to cover. But don't worry, we'll break it all down for you. Well, today we'll delve into the specifics of FHA mortgage qualifications. First, let's understand what an FHA mortgage really is. An FHA, or Federal Housing Administration mortgage, is a type of home loan that is backed by the U.S. government. It was established back in the 1930s during the Great Depression to help stimulate the housing market by making home loans more accessible to the average American. One of the most significant benefits of an FHA mortgage is that it allows for a lower down payment than conventional mortgages. Typically, conventional mortgages require a 20% down payment, but with an FHA mortgage you may be able to put down as little as 3.5%. This can make home ownership a more achievable goal for many people. Furthermore, FHA mortgages are known for their more lenient credit requirements. This means that even if your credit score isn't perfect, you might still qualify for an FHA mortgage. These loans are designed to help those who might not meet the strict criteria of conventional loans, including first-time home buyers or those with lower income. Another advantage of an FHA mortgage is that it offers protection to the lender. Because the loan is government-backed, lenders are more likely to approve applications, knowing they have this additional security. Now that we know what an FHA mortgage is, it's time to understand its qualifications. The very first qualification for an FHA mortgage is your credit score. This simple three-digit number becomes a crucial factor when you're looking to secure a loan. The FHA sets a minimum threshold for the credit score. As of 2024, this threshold stands at 580 for a 3.5% down payment. However, it's important to note that having a credit score of 580 or above doesn't guarantee approval. Lenders often impose their own credit score requirements, which are typically higher. Why, you ask? That's because your credit score reflects your credit worthiness. A higher score indicates a lower risk for the lender. Moreover, a higher credit score can also work in your favor by potentially securing you a lower interest rate on your mortgage. It's a win-win situation, so ensure your credit score is in good standing. Next, we're diving into your income and employment history. This is a significant factor in securing FHA mortgage. You see, lenders are all about financial stability, and a steady employment history is a testament to that. They want to be confident that you can keep up with your mortgage payments, and a job that you've held for at least 2 years gives them that assurance. Don't worry, climbing the career ladder within the same industry isn't frowned upon. It's quite the contrary. That usually falls under the category of growth rather than instability. However, watch out for frequent job hopping or large employment gaps. These could potentially indicate an unstable income and lead to some raised eyebrows. Essentially, a steady, reliable job is not merely a paycheck, but a golden ticket to your FHA mortgage. Then we need to consider your debt-to-income ratio. Now, this might sound a bit complex, but it's actually quite straightforward. Essentially, it's a comparison of how much you owe to how much you earn. This ratio is a key component in FHA mortgage qualifications because it gives lenders a clear picture of your ability to handle the financial responsibility of a mortgage. In the simplest terms, it's a way to measure whether you can comfortably afford to repay the loan. Now, how is it calculated? You simply divide your total monthly debt by your gross monthly income. The resulting number is your debt-to-income ratio. So, if your total monthly debt is $1,000 and your gross monthly income is $4,000, your debt-to-income ratio would be 25%. You might be wondering, what's an acceptable debt-to-income ratio? For an FHA mortgage, the ideal ratio is typically no more than 43% when you include the new mortgage payment. But remember, this is just a base guideline. There are exceptions based on various factors such as your credit score and savings, and other compensating factors. It's also worth noting that a lower debt-to-income ratio is generally viewed more favorably. It indicates that you have a good balance between debt and income, suggesting that you're less likely to default on your mortgage payments. So to increase your chances of qualifying for an FHA mortgage, it's beneficial to lower your debt as much as possible to give yourself the greatest chance of being approved. Lastly, the property you're planning to buy must meet certain standards. If you're securing an FHA mortgage, the Federal Housing Administration mandates these standards to ensure the home is safe, secure, and sound. They're not just arbitrary requirements, but essential to protecting your investment and well-being. The property must be your primary residence. This isn't a loan for investment properties or vacation homes. It's about making home ownership attainable for more people. And that begins with the home you live in every day. Next, the property must pass an FHA appraisal. An FHA-approved appraiser will evaluate the home and its value. They'll look for things like structural integrity, safety features, and overall condition. If there are major issues like a leaky roof, faulty wiring, or a crumbling foundation, they'll need to be addressed before the loan can be approved. The home also needs to meet specific health and safety standards. This includes things like ensuring the home is free of lead-based paint, which is especially important in older homes. It's all about making sure you're moving into a home that's safe for you and your family. Lastly, the property must be a certain distance from high-pressure gas lines, hazardous materials, and other potential risks. This is to ensure your safety and the long-term viability of the property. So make sure the property you choose meets these standards. It's not just about securing a loan, it's about ensuring your new home is a safe, secure, and sound investment. So we've gone through the qualifications for an FHA mortgage. Let's quickly recap. First, we discussed what an FHA mortgage is. It's a loan that's insured by the Federal Housing Administration, designed to help borrowers with lower credit scores and smaller down payments secure a home loan. Next, we dove into the first qualification, your credit score. It's crucial to note that the FHA requires a minimum credit score of 580 for a loan with a down payment of 3.5%. Then we moved on to employment history. The FHA wants to see a steady employment history for the last 2 years. This doesn't necessarily mean you need to have been in the same job for 2 years, but rather you should be able to show consistent income over this period. Following employment history, we examined the importance of your debt-to-income ratio. This ratio is a comparison of your gross monthly income and your monthly debt payments. The FHA typically wants to see a debt-to-income ratio of less than 43%, but exceptions can be made if there are significant compensating factors. The final FHA mortgage qualification we covered was property standards. The home you're hoping to purchase with an FHA loan must meet specific safety, security, and soundness requirements. This includes a proper appraisal from an FHA-approved appraiser. So, in essence, to qualify for an FHA mortgage, you need a minimum credit score of 580 or 500 with a larger down payment, a steady 2-year employment history, a manageable debt-to-income ratio, and a home that meets FHA property standards. And there you have it, all the qualifications you need to secure an FHA mortgage. Good luck with your home buying journey.